Friends, welcome back to our channel OMSAI Bhojanapalli.
So, in the last class, we discussed the concept of arbitrage pricing theory. We will do one more problem in the arbitrage pricing theory, that is question number 28. I think we did question number 26 and 27. We will do question number 28. Then do 3 problems, 2 miscellaneous sums, and 1 problem relating to coefficient of variation. We will quickly complete the 3 sums also. Then we will move on to the next chapter, capital budgeting. In that we will be doing for another 3 classes, leasing in capital budgeting. Very simple but very frequently asked area in the examination. Almost in most of the examination, a problem from leasing is being asked. So for another 15 or 20 days, you can happily come to the class. It will not be so much overloaded with concepts. It is more understandable, much more simpler. When we revisit derivative segment only, again little bit complication starts. Okay. So we'll try to complete the capital budgeting under leasing, uncertainty and other capital budgeting concepts. We'll also discuss the equity valuation, one chapter left out. We'll also discuss mutual funds. Once all these are completed, we'll be left out only with the main chapter, derivatives. Is a heading in which we'll be having lot of chapters like options, futures, application of derivatives, interest rate risk management, interest rate swaps, currency swaps, etc. That will be the last leg of the session where we'll be discussing for the last 1.5 months mainly the concepts of derivatives. We'll conclude the session with a small chapter, mergers and acquisitions. This is the plan for the remainder of the batch. So as usual, I'll put the plan, but we should be implementing it. So it all depends on how focused you are in listening to the class. Can I proceed on? Now, please. Just to summarize, now the entire chapter, arbitrage pricing theory. We saw that risk of a security is nothing but its variability in returns. Return of a security may vary due to 2 reasons. It varies because the system varies, or it varies because of random factor. We call that as systematic risk and then unsystematic risk. Systematic risk is measured through variance of market portfolio and the beta. Unsystematic risk through the error coefficient. Sharpe single index model says that systematic risk is beta squared, sigma m squared, and unsystematic risk is sigma ei squared. So in all the index models, whether it is CAPM or Sharpe index, etc., we take market as a proxy for the system. So when the market varies, the security return varies and the system is represented by the market portfolio. But arbitrage pricing theory says that what is representing the systematic risk is not the market portfolio, but what makes the market portfolio varies, which we call it as macroeconomic factors. Examples are GDP, interest rate, inflation rates, energy risk, exchange rates, and so on. There are so many macroeconomic factors. So when we say beta is equal to 2 times, we mean that when the market portfolio changes by 1%, the share return changes by 2%. In that case, we assume that for whatever reason the market portfolio change, it may be due to inflation or what interest rate, anything. For all the reasons, the security is sensitive 2 times. It need not be always so, because some securities may be sensitive to one macroeconomic factor and not to another. We had an example. There was a airline company and there is a power utility company. Two macroeconomic factors, GDP and then interest rate. We saw that airline companies' return is very much linked to the GDP, but a power supplying company need not be having that because it is a utility service unaffected by the business cycle. If I say beta is same for 2, it means that they react 2 times either due to change in GDP or change in the interest rate, which we saw it is not really so. So hence what APAT suggests is that for every macroeconomic factor, how the security return behaves. We should calculate a independent beta for each and every macroeconomic factor, that we call it as factor beta. That is nothing great. Regress the security return for each and every macroeconomic factor. Find the float, find the slope, which is called as beta. For example, x-axis have as GDP, y-axis have as security return, find the beta. X-axis have a interest rate, y-axis have the security return, calculate the beta and so on. Like that, regress for every macroeconomic factor, the security return to find out the beta, which we call it as factor beta. This factor beta can be positive as well as what? Negative. Then what we saw is the return of a security KE is equal to lambda 0 plus beta 1 lambda 1 plus beta 2 lambda 2 and so on. Where beta 1, beta 2 etc. are factor beta, lambda 1, lambda 2 etc. are factor risk premium, and lambda 0 is the risk free rate. Now the question is how to find out the factor risk premium. That we saw in the previous sum. If you want to find out a risk premium for a macroeconomic factor, GDP, construct a portfolio which is having a beta of 1 for that particular factor and beta of 0 for the other factors. That portfolio will be having a return. The return you compare with the risk-free return, and the difference is called as risk premium for the GDP factor. Suppose I want to find out the premium for the interest rate. May find out a portfolio, construct a portfolio which is having a factor beta of 1 for the interest rates and factor beta of 0 for the other factors, and find the return of that portfolio, compare with the risk-free portfolio. The difference is a risk premium for interest rates and so on is what APAT says for calculating the risk premium. Next, how to construct such portfolios with the target beta. It can be constructed using the following mix. We can have a portfolio having an investment. We can have a portfolio having a borrowing. We can have a portfolio having an investment in risk-free asset. We can even have a portfolio having a short sell. These are all the various combinations I can make. Short sell is an alternative to borrowing, we say. In case of borrowing, you borrow money. In case of short sell, you borrow shares, sell it, and then realize money for making investment. But the advantage of short selling is going to give you a negative factor beta situation inside the portfolio, which is able to reduce your overall portfolio risk, which is not in case of borrowing, which in fact increases the risk itself. Then we discuss about say the concept of that is zero beta, which we discuss risk-free return. When you have a portfolio which is having a negative factor beta due to the security or negative factor beta due to the short selling, we can even reduce a beta to 0 for the entire portfolio. The return can be called as risk-free return. Suppose that risk-free return is more than the risk-free asset given outside the stock market. In such case, the entire capital market line also changes. These are all the issues we discuss in this area, arbitrage pricing theory. Everybody having the clarity or not? Now, one more problem, let us do it. Then I have given you the notes or not. For APAT, last class I have given you the notes. I hope I have all gone through it. And I have given you the solution also for some of the unsolved problems in the portfolio theory. We'll solve one more APT problem and 3 more problems quickly before you go for the leasing and capital budgeting. Okay. Now, before I start, only request is lot of effort is put in the classroom both by you and by me in the chapter portfolio theory. You also came for so many classes. I also spoke for what? So many classes. All this should be productive only when you immediately revise and then what? Consolidate it. It is a request. Please go and revise immediately. I am saying this chapter, if you postpone the revision process, you will forget, because already it may be fragile, because so many concepts, lot of intricacies involved, small differentiation made between various theories. It is really a very deeply concept based chapter only. I want you to revise entire chapter. Don't look at only problem and solution. Every notes I have given word by word. One should try to understand, or say just try to visualize it. Then only you'll be getting a full grip over the chapter. Worth the spending time. 2 or 3 days you can even sacrifice sleep, and then what done? Revise this portfolio chapter. Other chapters now which are going to follow are not so difficult, relatively very simple, workman-like chapter where we have to do a lot of workings, that's all. More computations involved, but less speaking or less concept that needs to be discussed. For me also, at least for another 1 week rest, because I have to only come here and what? Do problems and solution. I need not be speaking so much, need not have so much anxiety whether you understood or not in the remaining chapter to follow. That will come back once we start with the derivative segment. Can I proceed? And please, one more request, when you start listening and all today, how fast we complete these chapters depend on how fast you copy the solutions, okay? Because more you spend time in copying, more the class gets dragged. If you copy fast, we can transfer this time to more areas where discussion may be required. This what I am discussing is not unimportant. Leasing and all is very regularly asked in the examination, but not such great concept what I am discussing in the other areas like portfolio management and derivatives. Can I proceed or not? Now, take please question number 28. Take question number 28. An RTP question. Take question number 28. Mr. X owns a portfolio with the following characteristics. Settle down. Can I proceed on? No. Security A, security B, and risk-free security. Factor 1 sensitivity 0.8, 1.5, 0. What is this 0.8, 1.50? Tell me what it is. Factor 1 beta. Sensitivity or variability means what? Beta. Factor 1 beta is 0.8, 1.5 and 0. Factor 2 sensitivity 0.6, 1.2 and then 0. Why we have 0 as the beta for the risk-free security? It does not react to any market, say macroeconomic factor is the meaning. Expected return 15, 20 and then 10%. It is assumed that security returns are generated by two-factor model. If Mr. X has 1 lakh to invest and sells short 50,000 of security B and purchases 1,50,000 of A, what is the sensitivity of X portfolio to the two factors? If Mr. X borrows 1 lakh at a risk-free rate and invests the amount he borrows along with the original amount of 1 lakh in the security A and B in the same proportion as described in part 1, what is the sensitivity of the portfolio to the two factors? Okay. Sorry, this problem is the examination sum. The previous one what we did is the RTP problem. Okay, this is one of the past examination question. Please go through the question before I start with the solution. Go through it quickly, please. Shall we start or not? No. There are two securities, A and B, in the first part of the question. Okay. How much money I'm having, own wealth, how much I'm having? 1 lakh. But I want to invest how much in A? 1 lakh. I have only 1 lakh rupees, but I have to invest how much? 1 lakh 50 in A. What are two options for me? Borrow 50,000 and then invest, or what? Short sell at 50,000 and then invest. So first option says you have to what? Short sell. How much are you going to short sell? 50,000 of B. Now they are asking you to find out what is the portfolio beta in this particular case. Can we start or not? Very simple. Let's write down solution to question number 28. Let us do it together. Question number 28. Let us do it together. Okay, can we start now? Now, part 1. Factor beta for the portfolio. They have two factor model now. Factor 1 beta, factor 2 beta. Both they are going to find out in the same slide. Part 1. Factor beta for the portfolio. Factor beta for the portfolio. Shall we start or not? Now. Security, value, proportion, factor 1 beta, weighted beta 1, factor 2 beta, weighted beta 2. That should be changed. Make it as weighted beta 2. Okay, later I can change. Can you see it now? Okay, let's start together now. Security A, security B. Security A, security B. Can I start? Now, how much I am investing in security A? Everybody, 1,50,000. 1,50,000. How much I am investing in security B? Minus 50,000. I am not buying the share in the market. I am taking a short position. I am taking a short position. Understand that this short position in the derivative segment, you can also learn that we can even take in a futures market, which works entirely different. Can I say? So 1,50,000 in A, 50,000 in B short position. Risk-free asset, nothing. I am going to invest nothing in risk-free asset. Tell me what is my present wealth? 1 lakh. The present wealth is 1 lakh. Okay. Proportion. What is proportion of A to my total wealth? 1.5. Proportion of B is minus 0.5. Risk-free asset dash. The total is 1. Beta, factor 1 beta for A. Look at the problem. What is factor 1 beta for A? It is how much? 0.8. What is factor 1 beta for B? Tell me what it is. 1.5, 0.8, 1.5. And the risk-free, no need to write it. Can I say? Weighted beta 1. 1.5 into 0.8 is going to give me 1.2. Minus 0.5 into 1.5 gives you minus 0.75. But taking a short portion, I am able to reduce the risk of my portfolio, right or not? Tell me what is the total risk of 0.45. The portfolio beta for factor 1 is 0.45. Factor 1 beta for the portfolio is 0.45. Can I proceed or not? Next. What is beta 2? Factor 2 beta for A and B, 0.6, 1.2, 0.6 and then 1.2. The weighted beta is 1.5 into 0.6, 0.9. Minus 0.5 into 1.2 minus 0.6. The factor beta 2 for that is 0.3. The factor beta is 0.3. The factor beta is 0.3. Everybody, are you comfortable or not? Okay. Shall I proceed? Now, step 2. Next time what they say is, I am also going to borrow, how much rupees? Tell me. Second step, I am going to borrow how much rupees? 1 lakh. Already I have 1 lakh. I am also going to borrow what? 1 lakh. My money how much in hand? 2 lakhs. 2 lakhs I have no. I am going to invest how much in A and B? In the same proportion what I am having in the earlier portfolio. That means with 1 lakh I will invest 1 lakh 50 in A. Yes or no? With 2 lakhs in hand, how much I invest? 3 lakhs. I will invest in A. I will short sell what? 1 lakh. Everybody, are you following what I am saying? That is, only thing is, I am introducing a borrowing in this portfolio and maintaining the same proportion for A and B. Everybody following on? Look at the question. If Mr. X borrows 1 lakh at a risk-free rate and invests the amount he borrows along with the original amount of rupees 1 lakh in A and B in the same proportion described in what? Part 1. What is the sensitivity of the portfolio to the two factors? Everybody accept or not? No. So can I proceed? Write down. Next, part 2. Factored portfolio beta with borrowings. Part 2. Factored portfolio beta with borrowings. Factor portfolio beta with borrowings. Factor portfolio beta with borrowings. Everybody, can we start or not? No. Same column, security, value, proportion, beta 1, weighted beta 1, beta 2, weighted beta 2. Make a change there. Security, value, proportion, beta 1, weighted beta 1, beta 2, and then weighted beta 2. Last column, please make a change while copying it. Now, can you start or not? Tell me, what are all the securities I am having? A, B, under risk-free security. A, B and risk-free security. Answer my question. I have 1 lakh in hand. I will borrow what? 1 lakh. The total money available for investment how much? 2 lakhs. Will I invest 2 lakhs in A? More than 2 lakhs? More than 2 lakhs. I invest 1.5 times of the money in hand. Yes or no? How much I invest in A? 3 lakhs. Invest in A? 3 lakhs. Invest in A? 3 lakhs. And how much I have to short sell B? 1 lakh. I have to short sell B? 1 lakh. How much I have to borrow? 1 lakh. And what is the total wealth in hand? 1 lakh. I have 1 lakh rupees. I borrow 1 lakh. I short sell 1 lakh. The total money in hand is how much? 3 lakhs. Which I put in what? Security A. That is what is happening. Right or not? No. Tell me the proportion of A is how much? 3. B is minus 1. Risk-free is minus 1. It is 1. 3 minus 1 and then 1. Beta 1. Factor beta 1. Answer my question. It is 0.8, 1.5, 0. 3 into 0.8, 2.4 minus 1.5, 0 gives you 0.9. Minus 1.5, 0 gives you 0.9. Factor beta 2. What is factor 2 beta? Tell me it is what? 0.6, 1.2, 0. 0.6, 1.2, 0. That is 3 into 0.6, 1.8 minus 1.2, 0, 0.6. 0.6. I hope everybody comfortable or not? Okay. Now, see. In the previous case, the beta of the portfolio is 0.45. Now the beta became what? 0.9. In the previous slide, the beta of factor 2 beta is what? 0.3. Now the beta became what? 0.6. In my view, both are same portfolio only. In both portfolio, invest in what? A and B in the same proportion. A and B beta did not what? Change. Tell me what made the second portfolio beta higher than the first portfolio beta? Tell me. Simple. Second portfolio is levered and first portfolio is what? Unlevered. This is levered beta. That is what? Unlevered beta. Both are having same investment only. A and B package. I am investing in what? Both. Proportion also is what? Same. Only thing is in the first portfolio it is all equity investment. My 1 lakh I invested. Yes or no? In the second case I am going to have what? A levered investment. But I have borrowed. Yes or no? In that case, we can even counter check our answer here. Levered beta is equal to formula. Levered beta is equal to what? Unlevered beta into debt plus equity divided by equity. Without tax we are having. Right or not? In this case, what is debt equity ratio? 1:1. You know, my own money is 1 lakh. The borrowed money is 1 lakh. Can you check it or not? Write down notes. Write down notes. Point number 1. Point number 1. In part 1 and part 2, in part 1 and part 2, the portfolio is same. In part 1 and part 2, the portfolio is same. But yet the beta is different. In part 1 and part 2, the portfolio is same, but yet the beta is different. But yet the beta is different. Why? Correct. Question mark. Why? Tell me the answer here. Part 1 is, right, part 1 is what portfolio? Unlevered portfolio. Part 1 is unlevered portfolio, while part 2 is levered. Part 1 is unlevered portfolio, while part 2 is levered with a debt equity ratio of, while part 2 is levered with a debt equity ratio of what? 1:1. Part 2 is levered with the debt equity ratio of 1:1. The debt equity ratio of 1:1. Can I proceed or not? Next. Point number 2. Point number 2. The relationship between the levered and unlevered beta, the relationship between the levered and unlevered beta can be established as follows. Can be established as follows. Can I proceed or not? Now, write the formula and then substitute. Beta levered is equal to, beta levered is equal to, I want you to answer, what is the formula? Beta unlevered into debt plus equity divided by equity. Debt plus equity divided by equity. D is to E is equal to what? 1:1. D is to E is equal to 1:1. Okay. Factor 1 beta levered is equal to, I want to find out the levered beta of factor 1. Okay, factor 1 beta levered is equal to, what is unlevered beta? 0.45 into debt plus equity 1 plus 1 divided by 1 is equal to 0.90. Is equal to 0.90. Factor 2 beta levered is equal to, factor 2 beta levered is equal to, what is unlevered beta? 0.3 into 1 plus 1 divided by 1. Debt plus equity by equity is equal to how much? 0.60. That's how one can confirm the levered and unlevered beta for both the factors. Everybody, I think are all comfortable or not? Now, with this we complete the solution to this particular problem. Now, all the core theories in this portfolio has been completed. We discussed risk return profile, Markowitz, CAPM, Sharpe single index model, and then arbitrage pricing theory. Efficient market hypothesis is a debate whether market is efficient or inefficient. How to identify that? We'll discuss that after the chapter. Mutual funds later. That will be keeping it on hold. Okay. Otherwise, every other aspect has been completed. I just want to do two miscellaneous sums. One is an exam problem. Another is the workbook sum. And then do question number 7, which has not been done in between, called as coefficient of variation. All this will try to complete another half an hour's time and then start with the next chapter. Can I proceed or not? Now, please. take question number 45 and question number 46. Please, 45 and 46. Don't talk, please. Shh. Stop talking. If the price of a bond, very simple question. If the price of the bond in the beginning of the period is $100 and it is 105 at the end of the period, coupon interest rate during the period is $7. US dollar appreciates during the period by 3%. Find the return on investment in terms of home currency. That's a question which has been asked. Now, we all should be knowing that this we are discussed in the IFM itself. When I invest in my country, what I earn is ultimately what I take, right or not? Suppose I make a deposit in State Bank of India, the bank gives me an interest rate of 9%. So what I earn is how much percent? 9%. But if I make a deposit outside India in a dollar bond or something, I earn some interest from the dollar. Tell me, is that interest ultimately what I enjoy? Need not be, because always in foreign currency investment, there's going to be a gain or loss on conversion as well as what? Reconversion. That is going to augment my income or what? It is going to erode my income. So always in case of foreign currency, it is income adjusted for what? Premium or discount. Everybody, you all remember or not? So in this case, so it is a foreign currency investment. Normally return is nothing but the capital gain plus what? The interest or dividend divided by the year beginning price gives you the return. Respond yes or no. In that case, we are going to have a conversion and reconversion amount also that should be factored in while calculating return from the foreign currency investment. Everybody, can we start or not? Now, let us do this problem by assuming an exchange rate. For that, it becomes much more simpler for you to understand it. Okay, any exchange rate you assume, it is not going to alter my answer, because from the assumed rate only it grows up by 3%. Enough, right or not? So can I start doing the solution together? Write down question number 45. Take question number 45. Shall we start up? Write down. Let spot rate be $1 is equal to 50. Let spot rate be $1 is equal to rupees 50. $1 is equal to rupees 50. We just assume it. Can I proceed or not? No. Can I start doing the solution? First, investment made today is equal to investment made today is equal to, tell me, I am investing in rupees or dollars or dollars. How to get the dollar? By purchasing the dollar by paying rupees. Investment made today is equal to, tell me what into what? $100 into 50 rupees. Investment made today is equal to $100 into 50 rupees. Investment made today is equal to $100 into 50 rupees. So tell me how much rupees it is? $100 into 50. What is the amount here? So they invested 5,000. Now, B, realization. Okay. Answer me. I realize how many dollars? $105, and I also receive what? $7 as what? Interest. That is a $100 bond I am selling after 1 year at $105. I am also receiving what? $7 interest. Right or not? That means realization is number right? $105 plus $7 into Today's exchange rate or exchange rate prevailing after 1 year or exchange rate prevailing after 1 year. Okay, just leave one line space and write working note. Exchange rate after 1 year. Exchange rate after 1 year. Answer me, dollar has appreciated or depreciated? Appreciated. It is appreciated by how much percent? 3%, no? So after 1 year, $1 is equal to rupees 50 into how much percent? 103%. $1 is equal to rupees 50 into 103%. Tell me the answer here. Rupees 51.5. So $105 plus $7, $112 I have in my hand after 1 year or not, which I sell at how much rupees? 51.5. 51.5. Tell me the realization here. 112 into 51.5. Number? 5,768. 5,768. Respond. Can I put it or not? Now. Third is return is equal to, what is return? 5,768 minus what? 5,000. I invested 5,000, I got 5,768. Interest and capital gains together divided by how much I invested? 5,000. Everything is 1 year, so into 100. Tell me the return I am earning here. 15.36%. Please, 15.36%. Return is 15.36%. Everybody, are you comfortable or not? No. That's all. The answer is over here. It is one of the past exams. We'll be seeing the next part. Okay. So, very simple. If you see, I invested 100, I got 112. Yes or no? Where 7 rupees is, $7 is what? Interest, and $5 is what? Capital gain. I earned $12. In dollar term, you earned how many dollars here? $12. Out of 100 investment, that means I have earned a 12% return. Yes or no? The foreign currency bond, the euro bond, has given me how much return? 12% return. But ultimately, how much I earned is how much? 15.36. Why a 12% return compounded to 15.36? The reason is I have a gain on conversion. When the foreign currency appreciates, as an investor, I'll be realizing more rupee than what it is invested. Hence, I'm having an extra gain. Respond yes or no. This is what we discussed in the covered interest arbitrage. Right or not? So the interest rate between two countries and exchange should be satisfying what? The interest rate parity. Can I proceed or not? Now. Same way, let us complete the next sum, question number 46. Take question number 46. Now, don't think, sir, we have made an assumption how much rupees? 50 rupees. Any amount you assume will end up with what? Same 15.36 only, because from which base figure you assume, from there the appreciation is going to what? Take place. So it is given in percentage, so it does not matter. Everybody following on? Now, next take, I think page number solupa. 190? Okay, please. Take question number 46. Take question number 46. Price of a bond just before maturity is just before a year of maturity is $5,000. His redemption value is $5,250 at the end of the set period. Interest $350 per annum. The dollar appreciated by 2% for the set period. Calculate the rate of return. A past examination problem for 5 marks. Can you start or not? Now, just 1 minute, let us do it. Question number 46. Question number 46. Let $1 is equal to 50 rupees. I take 50 and easy to multiply. Let $1 is equal to 50 rupees. Please. Let $1 is equal to 50 rupees. A. Investment is equal to, all of you tell and write together, investment is equal to $5,000 into 50. Investment is equal to $5,000 into 50. How much am I investing? 2,50,000. $5,000 into 50, rupees 2,50,000. Next. B. Realization realization is equal to, point B, realization is equal to, how much I get? $5,250 plus $350. Realization $5,250 plus $350 into, leave one line space, write the working note, into, leave it, write one line space and write working note. $1 is equal to, working note, if you want to give the heading, what is the heading of the working note here? The exchange rate after 1 year. Working note heading is exchange rate after 1 year. Exchange rate after 1 year. Right? $1 is equal to, $1 is equal to, what into what? 50 rupees into, dollar depreciates or appreciates? Appreciates. How much percent? 2%. 50 rupees into 102%. 50 rupees into 102%. How much going to be here? 51 rupees. $1 is equal to 51 rupees. Go to the main statement. It is 5,350 plus 5,250 plus $350 into 51 rupees. Tell me what is the realization amount? 1%. 2 lakhs? 85,600. 2 lakh 85,600. Realization is 2 lakh 85,600. 285,600. Now, point C, return is equal to 285,600 minus 2,50,000. 285,600 minus 2,50,000 divided by 2,50,000. 285,600 divided by 2 lakh minus 2,50,000 divided by 2,50,000 into 100. Can you tell me the return here? 14.24% is equal to 14.24% is equal to 14.24%. I hope everybody are able to understand or not? No. With this we complete 45 and then 46. Now, please take question number 7. Take question number 7. I have already taken it. Take question number 7, please. It's a small concept, but not very much relevant to our sharp single index or any portfolio theories. But this will be very relevant for the capital budgeting chapter and uncertainty, where we'll be discussing about Hiller's model later. Let's discuss this concept called as coefficient of variation. Give the heading, coefficient of variation. I am not saying covariance. I am saying what? Coefficient of variation. Give the heading, coefficient of variation. Please. Okay. Now, risk is the uncertainty in the return. Or any uncertainty in the number, we call as what? A risk. We measure the risk through the standard deviation. Yes or no? Risk measured by what? A standard deviation. Please. The risk is measured through standard deviation. How much a data varies around the mean is called as the standard deviation. Bigger the standard deviation, more the risk, and smaller the standard deviation, lesser the risk. No standard deviation, no risk. Everybody respond, yes or no? So now, let us see the disadvantage of standard deviation as a measure of risk and how to overcome it in this concept called as coefficient of variation. Okay. Now, 2 persons wrote CA final examination and came out of the examination hall. Okay. The SFM exam. They wrote what? Who is shouting here? Stop. Can I proceed up? No. 2 persons wrote SFM examination and then came out of the examination hall. We conducted an interview of both of them. Okay, how they wrote the exam. Okay, please. Shh. See, stop talking. One said, the standard deviation, person A said, the standard deviation over my expected mark is 3 marks. It is how many marks here? 3 marks. It is 3 more or less my expected mark I am expecting. This is a standard deviation given by what? A. Can I proceed? Now, B says the standard deviation over my expected mark is 7 marks. How many marks here? 7 marks. Now, tell me, whose examination is very risky? A or B? You know, when B came out, he said, I may get 7 or 7 more or 7 less than what? My expected mark. The deviation around my expected mark is how much? 7 mark. X said, I have only 3 deviation. I'll be getting either more or less 3 from what I'll be expecting to get. So in that case, you say that B is having what? More uncertainty in his marks compared to what? A. In right or not? Yes or no? So who is more risky here? B examination is what? More risky compared to how A has written the examination. Yes or no? Then next question you asked, what is the expected mark you are going to get? Yes or no? That's an important question or not? Now, A said, I expect to get, A bar means average. Now, he puts optimistic, pessimistic, most likely all this he does here. Please. Shh. A says, I expect to get around 15 marks. How many marks here? 15 marks. Okay. Now, people are getting. I expect to get how many marks here? 15 marks. Is what A said. Yes or no? And when I asked B, B said, I expect to get 80 marks. How many marks here? 80 marks. Now tell me, whose exam is risky here? 3 is a deviation around a mean of 15. Yes or no? But 7 around mean of what? 80. Now that means independently the standard deviation may not communicate great things, because when I say standard deviation, around what mean? Question arises. Standard deviation is a deviation. More it deviates, more risky. Less deviates what? Less risky. Understandable. It is an absolute measure. It is going to be what measure? Absolute measure. The question asked, no, is a deviation around what? What mean? Question arises. Everybody yes or no? Now, that is what you want to measure through here. Concept called as what? Coefficient of variation. What is the concept? Coefficient of variation. Very simple formula. Standard deviation divided by mean. Sigma divided by x bar is going to give you the coefficient of variation. Can you tell me what is the coefficient of variation for A? It is 1 divided by what? 3 divided by 15. What is the number? 0.2. For Y it is 7 divided by 80. What is the number? 0.0. Let us have 0.08, some number, 0.08. Tell me, which is having higher coefficient of variation? A, it is more risky. Which is having lower coefficient of variation? B, which is less risky. So, standard deviation sees the risk in absolute terms. Risk in what terms here? Absolute terms. Whereas coefficient of variation measures in what? Relative terms. It is not only standard deviation which is important, it deviates around what mean is important. A 7 deviation around 80 mean is lesser than a 3 deviation around what? Just a 15 mean. Everybody, are you following what I am saying? This is a coefficient of variation. Now, in our portfolio theories, we did not use this at all. We don't use what? Coefficient of variation. We can say the reason for different theories in different angles. For Markowitz, what he says is, he does not see the magnitude. Suppose 3, 15, 7 what? 80. He says more risk, more return, less risk what? Less return. For him both are equally good, both are efficient. Everybody yes or no? Suppose this is 2 for 18, what happens? This becomes what? Efficient. So there they say how much incremental does you want to take all determines on a utility curve. Yes or no? Because it depends on a risk aversion factor. I am not going to judge anybody's risk appetite through what? Coefficient of variation and all. Every security is efficient. If it is going to give me what? More return for more risk. How much more it gives is not a matter at all. Or even for extra 1 return, if 1% return, I may take what? 7% risk if a person wants to take risk. Everybody, are you following what I am saying? So, Markowitz does not worry about what? Coefficient of variation, because he says that everything depends on what? The utility factor. If you don't want to take this risk for this return, probably your utility curve may not run what? Tangent to this point, may run tangent to what? Any other point and so on. So, Markowitz does not use the coefficient of variation. Response is or no? And other theory is CML or CAPM or SML, everybody, they have another relative measure called as what? Beta. So what they say, they see the secondary in relation to what? The beta market portfolio. There also I don't take sigma, I take only what? Beta. There is also another ratio, yes or no? The ratio is much more better because I am having an equilibrium return to compare and ask for risk premium, yes or no? So in all the portfolio theories, we don't need to use what? The coefficient of variation, because the theories are premised on different arguments. Everybody, are you following what I am saying? But in capital budgeting, when I discuss an area called as Hiller's model, this is going to be a very, very important term upon which we select a discount rate for a project. Everybody following not? So this is a concept called as coefficient of variation. One thing sure, standard deviation is an absolute measure. But coefficient of variation is a relative measure. It is standard deviation over what mean? The question is what the answer for getting the coefficient of variation. Everybody have the clarity or not? Can I proceed further? Now give the heading concept of coefficient of variation. Have you written the heading or not? Write down point number 1. Standard deviation measures risk. Point number 1, standard deviation measures risk. Higher the standard deviation, full stop, continue, higher the standard deviation, more the risk, higher the standard deviation, more the risk, and vice versa. Higher the standard deviation, more the risk, and vice versa. Higher the standard deviation, more the risk, and vice versa. Everybody following or not? Next, point number 2. For example, standard deviation of marks. For example, standard deviation of marks of 2 students. Standard deviation of marks of 2 students and their expected marks. Standard deviation of marks of 2 students and their expected marks are as follows. Standard deviation of marks of 2 students and their expected marks are as follows. Sigma A 3, A bar 15. Sigma A 3 and A bar 15. A bar means what? Expected mark or average mark. Yes or no? Sigma B 7, B bar 80. Sigma B 7 and B bar is 80. I hope you are writing along with me or not. Next, point number 2 or 3? 3. In the above case, based on standard deviation, B seems to be risky. In the above case, based on standard deviation, B seems to be risky. Based on standard deviation, B seems to be risky. But really, A is risky because the 3 deviation is from a mean of 15, while 7 is from 80. Can I proceed? Last point. Point number 2 or 3 or 4? 4. It is not only important how much it deviates, it is not only important how much it deviates, comma, it is also important for how much mean it deviates. It is also important for how much mean it deviates. For how much mean it deviates. For how much mean it deviates. Okay. Sorry, last point. Point number 4 of 5. Coefficient of variation is a relative measure. Coefficient of variation is a relative measure. Coefficient of variation is a relative measure. Coefficient of variation is equal to, don't write COV, and a COV becomes what? Covariance. Altogether different concept. Okay. Coefficient of variation is equal to sigma by x bar. That means what? Standard deviation divided by mean. That's what I mean. Coefficient of variation is equal to standard deviation divided by mean. Standard deviation divided by mean. In this example, coefficient of variation is, put I and write A is equal to 3 by 15. A is equal to 3 by 15, 0.2. A is equal to 3 by 15.2. B is equal to 7 by 80, 0.08. B is equal to 7 by 80.08. And 0.0875 some number, leave it, 7 by 80.08. Everybody able to understand the concept of coefficient of variation or not? Now, let's take question number 7. The owners of safety limited are risk averse. Please. Just to test your memory, can you categorize the 3 types of investors? Yes, sir. But tell me the names. What are the names, sir? Risk takers, risk neutral, and risk averse person. Who is a risk taker? Who is a risk lover here? A risk lover is a person who pays money to take a risk. He pays money to want to take a risk. You pay money to buy a lottery ticket, yes or no? So he pays money to take a risk. And who is a risk neutral? He doesn't worry about the risk at all. Always goes for higher return option. Risk averse person will want more risk only when he is offered what? A premium for the risk taken. Yes or no? In all our portfolio theories, our investors are what? Risk averse person. When you discuss about derivative segment, they make an opposite assumption that investors are what? Risk neutral, and then go for the valuation. Everybody following or not? Now, let's go for the question number 7, please. I read the question, huh? No. The owners of safety limited are risk averse. They want to choose the least risky of the alternatives. Please. Data of 4 possible projects are as follows. A, B, C, D, expected return, which we call as what? Mean, average, and then standard deviation. Which is least risky in terms of standard deviation, which is least risky in terms of coefficient of variation. First question very simple. Which is having the lowest standard deviation? So A is having the least in terms of what? Standard deviation. Coefficient of variation is what by what? Standard deviation divided by mean. Can I put or not? Now, right now. Part A. Question number 7, part A. Part A. In terms of standard deviation, A is the least risky project. In terms of standard deviation, A is the least risky project. A is the least risky project. because of its lowest sigma. In terms of standard deviation, A is the least risky project because of its lowest sigma, because of its lowest standard deviation. Can I proceed? Next, part B, coefficient of variation. Part B, coefficient of variation. Can we start or not? Now, have the following column. First, project A, B, C, D. A project A, B, C, D. Expected return. What is the expected return of A, B, C, D? 12, 12 and a half, 13, 12.8. Expected return 12, 12.5, 13 and then 12.8. Standard deviation. What is the standard deviation of A, B, C and D? 2.9, 3.2, 3.5, 3. 2.9, 3.2, 3.5 and then 3. Can I proceed? Next. Rank already we just did it. Standard deviation rank is 1, 3, 4 and 2. 1, 3, 4 and 2. We rank based on standard deviation 1, 3, 4 and 2. Next is what? Coefficient of variation. Coefficient of variation. Standard deviation by mean. Got a 2.9 by 12. Tell me the number. 0.24. 2 decimals I round it off. 0.24. Check the number also. 3.2 by 12.5. How much is here? 0.26. 0.25 or 26. So right or not? Next. 3.5 by 13. I want number 0.27. 3 by 12.8, 0.23. 3 by 12.8 is 0.23. When you rank, what is the first rank here? D. Second rank should be A. Third rank should be B. Fourth rank should be C. 2, 3, 4 and 1. 2, 3, 4 and 1. Tell me in terms of coefficient of variation, which is least risky? D. Write down. D is least risky in terms of D is least risky in terms of coefficient of variation. D is least risky in terms of coefficient of variation. In terms of coefficient of variation. Okay. With this, we complete this chapter, portfolio management. Let us see the sums done and not done, and then we can just go for the next chapter. Please. Question number 1, 2, 3, 4, 5, 6, 7, 8, 9. Please. I'm not joking. I'm just going through any important sum I have left out. I want to say, now so many sums are there or not? So 9, 10 over. Yes or no? 11 also we did or not? Yes. 12, 13, 14. Then question number 15, 16. 17 I gave it as homework. It is there in the study material. I think just to conclude examination also, I think the same type of problem has been asked. 17 I gave it as homework. Okay. 18 done or not? Yes. 18, 19 over. 20 also done. 21, 22, 23, 24. 25 is a very basic sum. APT. They ask you to find out what? Rate. What the K is equal to what? Lambda 0 plus beta 1 lambda 1 plus beta 2 lambda 2 etc. Now they say the treasury bill rate is how much percent? 4.1. What is 4.1%? Lambda 0. Plus they given you factor beta, factor risk premium. To lambda 0 add what? 0.25 into 2.59, 0.3 into minus 0.66 and so on. If I add, I'll be getting the KE. There's an introduction sum, I left it. Everybody following not? So this I gave as homework. 26 done, 27 done, 28 done. 29 I given you the solution in the sheet. Okay. Last class I gave you a sheet or not? In the solution has been given. 29. 30, 31, 32, 33, all are levered, unlevered beta done. Yes or no? 34 also I think is a similar problem homework. 35 done. 36, 37 has been done. 38 is similar to 37 given as homework. 39 over, 40 over, 41 over, 42 solution given in the sheet. It is a past RTP question, so given in the sheet. 43, 44 deals with efficient market hypothesis. I'll be doing it later. 45, 46 today we have completed that particular sum. Yes or no? Now, I think I have given you 3 problems as homework out of 46. For all the 3, the solution has been given. 1 or 2 left over are all simple repeated types only. Everybody, are you comfortable or not? No. With this, we complete this chapter, portfolio management. Please, already clapped. Stop clapping. Can I proceed now?
Thank you friends. OMSAI Bhojanapalli.